So what are we talking about here? Inventory. So a good place to start is, what is inventory? We'll go through some inventory valuation methodologies, talk about 471, and then get into some of what all of us here need to know. So, what is inventory? That is a loaded question. Really, it depends on where are we in the vertical, because that definition does change a little bit. How are we valuing that inventory? And we'll talk about this a little bit since we each have different perspectives on this, but the perspective does matter. And as CPAs, we do need to sort of right the ship there and make sure that there's some level of consistency in the methodology. And then the last part here is determining cost basis. I think we each have a few stories that we can get into, but this is much more complicated than one would think, especially in an industry like this. We've talked a little bit before about seed-to-sale systems, inventory management software, and while we certainly don't want to insult any of our friends in the software industry, as I think it was termed before, there's room for improvement. And there's certainly room for improvement in how our clients and the industry as a whole does handle this cost basis.
And I want to interject that because I've been thinking about that since this morning. We need to do better, guys, at giving those people feedback on what we need from those kinds of systems. Because software engineers or developers are not accountants. And again, what we do is hard. And so the ability to be able to help people and give feedback, not just say, your seed-to-sale software sucks, that doesn't help anybody. If we're gonna bring the industry to a better place, we also need to be capable of articulating what we need from them in order to ask them to do better for us.
And by the way, they love free advice if it's brought about the right way. So some free consulting services are never a problem. And it can be a little self-serving, to be honest. I think we've each thrown our 2 cents in from time to time, but if you know that this report needs to be added, or let's create a dashboard, there's any number of use cases. A lot of them, if you approach them the right way, will actually play ball. So that's...
They don't know what they don't know as well. So grace is always good everywhere.
Well said.
Thanks.
So when we get into inventory valuation, well, actually even backing up a step, what is inventory? So looking at the different parts of the vertical, we have cultivation. So cultivation, that's actually pretty easy. Inventory's the plant. When we get into the dispensaries, that's also pretty easy. Inventory, that's your products, it's retail, what are you selling? It's in between that it gets a little funny because, well, you have a processor, well, you have work in process, you have any number of actual products, and valuing those products becomes tricky.
In addition, you also have things on the outside, potentially, that we get problematically as advisors, which is, does delivery have inventory? Does a wholesaler have inventory? From an accounting and tax perspective, we have opinions about that, and from a cash flow and a business operations standpoint, they have opinions about that, and from legal standpoint, there's a different opinion from that. So again, what is inventory is a very complex and nuanced question that you need to come to some pretty clear conclusions with your clients about before you start putting things on paper, because it's not just a box that you check for cost at the 1125A, and it's not just 8 lines that you're filling out on a tax return or putting on a financial statement.
I'd also just quickly add, in a dispensary, the cost, and when you look at the 471 principles, the cost is the cost of the product, but are there other activities going on in that dispensary that may be considered, deductible and includable in inventory? So that's where you kind of get into additional complexities in determining how to value your inventory.
And that's where, and you'll get sick of this word, documentation. That's where everything has to be documented and it has to be clear. And we will talk about that a lot. So getting into the 2 tests related to inventory valuation, it must conform the best accounting practices, and unfortunately in this industry that's a moving target. So that's really where this gets a little tricky, and that's where there's a bit of gray area as well, and it has to clearly reflect income. So our good friends 280E, every word that's there, which we will show again for your viewing pleasure, it really makes a difference here. So because it's a reduction of income, it becomes very, very important. And as promised, if you guys aren't all seeing this in your dreams, nightmares, tattooed on the inside of your eyelids, I would get there. These are the most important words for us at the moment.
Zach actually has this tattooed on him. You ask him to show it to you later.
Don't ask where. So we talked a little bit about inventory valuation at the different parts of the vertical. So dispensary, again, Dave alluded to some of the nuance there, but for the most part, you're really looking at what you buy the inventory for, pretty binary for the most part. Where we get into the cultivation side, into the processing, it gets a little more tricky, and this is where, as CPAs, we have a little bit of room here to really steer the client in the right direction. A lot of them will be very aggressive or have absolutely no idea at all. And in my experience, it's been that. There's nothing in between. Everything's cost of goods sold or none of it is. Everything is inventory or it's not. So things like raw materials, supplies, I mean, that seems pretty binary. Production-related wages, so direct wages. That's where things like timesheets really become very important. Again, documentation. Sorry. And then getting into the indirect costs. So maintenance, utilities. This is where having good books and records becomes really important. This is where making sure that there's that accounting staff in-house that's properly monitoring this, or if that's your role, making sure that you have everything properly documented so we can calculate what should be allocated to the cost of goods sold, what should be SG&A.
Jump in on audit. Okay.
So we get to the intent. So how does 280E affect everything we're doing here? Well, it's because you can't deduct operating expenses. So that makes the valuation of this inventory very, very important. So again, it has to clearly reflect the corresponding income. So you sold something, what's the corresponding cost basis? And what we need to talk about here, risk of doing it wrong versus doing it a little more simplified but getting it right, for whatever that means. So what we mean there, and I'm sure we have different opinions on what's right versus wrong, but going through quickly just jamming everything into inventory versus, okay, it's really only, depending where you're in the vertical, a more conservative look. So this is something that I know personally I've fought with clients back and forth on. I'm sure you guys have as well. It's a big consideration.
Zach, one quick question from the, as they're related, so this is, should shake and trim be inventoried? How do you all look at that?
Well, and that goes right to the question, or the old joke that if you put 5 accountants in the same room, you're going to get 7 answers.
Oh, we're lucky if it's only 7 answers here.
Right, because I have an opinion, and I'm sure you have an opinion, and Dave has an opinion, and you all
depends.
have an opinion as well, which is why valuation is so fascinating.
But
Is your slide, go.
oh, come on.
No, you.
One stage.
No, you.
But the answer is it depends. Depends on what the methodology is. But honestly, in my experience, yes. But there's always cases where it could be no, just to cover all the bases there.
And in my methodology, depending upon when I've engaged with the client. So again, I've got a whole cost analysis that says if I've had this firm from the very beginning, that's considered a byproduct in my inventory methodology, and it actually doesn't have a separate position that I take, because the cost of the plant and work in process for the plant and finished goods and the trim that comes from that, as a byproduct, when we look at regular manufacturing, what are we always trying to do? Well, we're trying to get paid for the byproduct that we already sunk the cost into. So it really does, in fact, depend, because I have inherited positions where I have maintained trim being something that we do separately value in inventory, and then there are positions where I do not do that based on size, cost benefit, and other sort of places that the tax position has taken.
But if it's part of the business plan, if it's part of the expected operations, you could make the justification that, yes, it should be.
Absolutely. Yeah.
I would definitely say that it is included in inventory. I think, you really need to look at the way it's accounted for. I mean, that's the key thing is how the books and records are accounting for those costs and making sure that they're consistently applied when you, go to prepare tax returns to make sure that you can support it. Again, it gets back to documentation.
Oh, yeah, and to be clear, it's included in inventory. It's whether it's separately valued
Yes.
it's included in inventory, yeah, absolutely.
But the easy answer, if it's a SKU, there you go.
Exactly.
But again, this goes to doing it wrong versus doing it right, but maybe not capturing everything. So again, it can be a case-by-case basis. It's not as simple as it may seem. Now, here's an interesting discussion point from depending on if you are in-house, if you're that outsourced CFO or the in-house CFO versus if you're preparing financial statements, tax returns, audits, et cetera. How do we get to that valuation and how are we justified? Katie, any thoughts?
Many. So for me, all roads lead to a tax return. I started in 2013 dealing with tax work. I started really as a bookkeeper for the industry because no one was doing bookkeeping. And then as soon as I had a set of books, people said, well, who's going to do our tax return? And I said, well, take it to your tax preparer. And they said, well, who's that? And I said, well, I guess that's me. And so again, I really did. I fell into that. I have a long and sordid story you don't care about how I came to this industry. But for me, really, the client base in Oregon has needed bookkeeping and a tax return because that's the industry and the state that I've predominantly worked in. So because all things move to being put on a tax return, my gaze when it comes to valuation of inventory is all about completeness. It's about the ability to be able to say, hey, is this reasonable? Year over year, when possible, reasonable. We're looking at accounting principles, right? We're just going back to 101 accounting. Is it reasonable? Is there a cost basis? And is there some conservatism? And then, how'd they document it? Because I am more conservative the less documentation you have. And I am willing to have an argument that goes to exactly where my bright line is, because I know exactly where that is as a tax practitioner, based on documentation. You can document it to the moon and back, and I still won't completely do something if I don't like that because I think it doesn't adhere to 280E or the like. So my gaze really, when I'm dealing with a tax return inventory valuation, I'm looking at an 1125 number. I don't care about what your price per unit is based on percentage of THC because it's not something that's going to go on a tax return for me. But for an internal position, that might be extremely important, especially as we come into, business segments and the like. And as tax is coming in Illinois and maybe New York and other places or federally, where they're floating this idea of a percentage tax, I'm going to start having to look at where how valuation is going to be impacted in relationship to that, and how much more documentation I'm going to need and assurance I'm going to need from the internal people doing that work in order to get to a good number that, again, because we're going on a tax return, clearly reflects income. I am not providing a fraudulent position for you. I want to clearly reflect your income on a tax return I'll sign under penalty of perjury.
To me, it's being consistent between the internal reports and the financial statements and what ultimately gets onto the tax returns. So, and what I mean by that, and we'll get into a little bit more when we get into the background of 471, is, where are those costs reflected internally in the client's financial statements? Because if you do look at 471, depending on where those costs are included in internal reports, they may or may not be deductible under 471. So to me, that's a big challenge. And then, what even adds to the complexity is if you have a client that has an audited financial statement, and now you got the GAAP principle you need to take into consideration as well. And, how does that jive back to the internal report and then again, ultimately reflected in the financial statements that would be acceptable to the tax returns that would be acceptable to the IRS as being compliant with 471.
And from the internal side, to give a little story here, acting as outsourced CFO for a large vertically integrated group, asked for the inventory reports. I mean, it seems like a pretty logical thing for the end of the year. It came back 0. And they had sales, tens of millions of dollars in sales. The issue was the inventory manager had no idea how to use the inventory management software. And so instead of learning or raising hand, he pass. Needless to say, there was a little bit of homework that had to be done. So we had to go back in time throughout the year, make sure we're properly capturing all the costs, making sure that they have a written process for how they're allocating all these direct and indirect costs to come up with what that number was. For some reason, management couldn't understand, oh, well, we control the whole vertical. We don't need to know what the cost base is. It's whatever we sold it for. That's not true. So first and foremost, having the proper process, making sure that the inventory staff, they know what they're doing. So whether it's, God forbid, in Excel or in a more sophisticated operating software, make sure they know what they're doing. I can tell you that was unpleasant. But with that in mind, go through, again, written documentation for the process, review the reports. Maybe don't wait till the end of the year. Just, throwing that out there.
Well, I think that speaks to the point of, back a couple of slides, where the risk of, our risk as CPAs is that we're not going to do it right, that we're going to do it wrong. And so somehow we maybe get paralyzed. And then we don't have the ability to be able to make a decision one way or the other. And that adds to our stress or our uninterest or dis-ease in getting involved with the industry. Leading me to my second favorite cannabis saying, which is 0 is almost always the wrong answer. But the process before technology, here's a classic example of the technology has stymied someone. Excel might have been the answer. But if Excel isn't the
No, it wasn't.
right technology to use, then that person won't use Excel. Like, please do your best. Even asking our clients to do their best, I've started with clients that have stained, scribbled pieces of paper for inventory valuation at the end of the year, and we've gotten to Excel. Huzzah! And now we're moving forward with being able to understand the technique, meeting the client where they are, being realistic and humble about what you know and what they know. I think in being able to add that value so that we're not at the end of the year with our pants around our ankles, quite frankly, it is really important. And so being able to do high touch there allows us to understand where the internal understanding and or valuation of inventory is coming from or not coming from, as the case may be, and where we ultimately want to get it to. Is it the financial statement? Is it for an audit? Is it for a tax return? Maybe we are not the final arbiters of where these numbers go, and so being able to understand that whole cycle of who's going to use this information is almost as valuable, if not almost more so, than actually valuing inventory right. Because we know we can amend everything if we need to.
And that also allows us to participate more, which ultimately we should want. So one of the good things that came out of this endeavor was, that's the one, was that we were able to change their month-end close process.
Right.
So we know that as part of the closing package, you have to have at minimum a screenshot from Metric. You had to go into the software, produce XYZ reports, and I wasn't signing off until I saw that, and management agreed. So those are the things that the good that can come out of this. And on to Dave for some 471 talk.
All right, so we'll get into just the background on 471. This is probably one of the more technical areas that, from a presentation standpoint, there's been a lot of just interaction and discussions in the earlier sessions. So I hope I don't bore anybody and
this is the exciting
put
stuff.
everybody asleep. But, in terms of background on 471, the key thing that I think, people just need to keep in mind here is just consistency in financial reporting and what ultimately it needs to be acceptable to the IRS, because 280E, they only allow deductions for cost of goods sold, right? So that's the key thing, is you got to get your inventory right. Can't deduct anything else. So the principles behind 471.3 is for retail and dispensaries. So it's really, we mentioned before, it's just the cost of the product and any necessary cost to acquire the goods. And that's all that's deductible for a retailer. We have been successful in some audits that we've had where, Massachusetts is a vertically integrated state. So we've been able to argue that some production activities are going on in dispensaries. But the IRS, the first thing they're going to think when they come in is that there's no production going on. It's just the cost of the product, and that's all they're going to allow. 471-11 is for your processors, your cultivators, really the manufacturing, go back to your cost accounting days, and it's, full absorption accounting and accrual basis accounting, and, you're looking at your direct costs and your indirect costs, and it's just a lot more, obviously expenses that you can pull into your cost of goods sold for a cultivator and a manufacturer. So some of the key items there, again, is just going to come back to consistency and how those costs are being reflected in your internal reports, and, are they acceptable under IRS Code Section 471. So indirect costs, and that's the key area. Obviously your direct costs, your labor and your product costs, that obviously can be rolled up into cost of goods sold under 471. The key area is your indirect costs. So there's 3 sections within 471.11 that guide the indirect costs. 471C21, little I guess you call it, is your indirect costs that are, if they are always includable in cost of goods sold, regardless of where they are included in the internal financial reports. So that's your repairs and maintenance, your utility costs, your indirect labor. Those costs, it doesn't matter where they are in your financial statements, your internal reports, they need to be included in inventoriable costs under Code Section 471. So that's, again, it's a key principle to really understand how these costs are being reflected and accounted for in the internal reports in order to get your 471 costs right on your tax returns. 471-2, these are costs that need not be included in inventoriable costs. So your marketing, interest, we talked about this earlier today, but depreciation that's in excess of what is on your books and records. These costs, and it's funny that they say need not in there, but it means that they can't be. So it's not your choice. You can't include them in cost of goods sold. And this is regardless of where they are, again, in the internal report. So if you have a client that has these particular costs in their cost of goods sold in their internal reports, you can't reflect them, in cost of goods sold on a tax return, or if you get audited, you're gonna have some issues. Depreciation, that's a key item. Again, that's one thing that we really, it's an area that we have a lot of discussions with clients on, because they want to write off everything either through bonus or 179, and we tell them that the IRS they're just not going to accept it. And then the last item is the 471-3 lies, I guess you call it. And that is, if the internal reports reflect these expenses in cost of goods sold, as long as these expenses are allowable under GAAP, they can be included in 471 in the tax returns. And one item I think that would, you can relate to is excise taxes on cultivation equipment. So if you pay property and excise taxes on cultivation equipment, those expenses can be includable in inventoriable costs. The key is that they need to be included in cost of goods sold in the internal reports. If they aren't, then they will not be acceptable. The IRS will pull them out.
So as you said, consistency.
Consistency, that's key.
Can I toss in a question, or do you want? We've got, I think, 15 minutes left. I'm getting a lot. This one has 6 votes. So, what are some best practices in tracking costs through a change in the unit of account? For example, plants going to drying flower, and so kind of talking about that whole growth cycle. Do you change the cost as plants go from, veg to flower to harvest, dry, cure, trim, off to the lab?
Well, by definition, the cost basis does change at each part of the vertical. A lot of times how we try to articulate it to clients is each part of the vertical should be a different operating entity for all intents and purposes, even if it's not from a legal structure standpoint. But that's the most simplified way to explain it to them in a way that it might make sense. So the short answer there is yes.
And for tax purposes, because I'm dealing with significantly smaller people, my answer to that is to try to say, let's think about it like a layer cake. Because cost layers, right? We all know cost layers, right? But cost layers is like it goes in one ear of the client, it falls out the other. But if we're talking about layer cakes, right? Then what I'm trying to ask the client to do is be able to say, great, when you add more frosting to your inventory, to mix a terrible metaphor, when you add more dollars through the process before you've sold it or before it's finished, what I have is the ability to be able to determine how far away from finished it is. Where are we going? Percentage completion. Because what am I trying to do? Accurately reflect income on a tax return. So I need a number in ending inventory value. That is often a blunt exercise when we first engage, and hopefully as we continue to be consistent and move through the process of getting better books, getting better records, doing better processes, having better technology, we're getting better at being able to make that number more granularly capable of accurately reflecting income on a tax return.
And yeah, I would just add to that, we do the same thing, that percent complete. So client one, their growth cycle may be 180 days. Maybe a different client, the growth cycle is 90 days. And so I want to be able to go in and for every strain at the farm, know what is this plant on day 89 out of 90, and that plant's on day 2 out of a day 180. What percent complete? What's the estimated yield? So we can look at equivalent units. So it's a lot of legwork. We find when we do that correctly, though, and we build it out on kind of a calendar, we can actually pretty accurately predict cash flows by plant, which happens to be very useful information for the clients to know. That Gorilla Glue plant, we think we'll get $83 or whatever on July 12th, so that helps them as well. So
yeah.
On
that regard, it depends on the sophistication of the client, because we've gone through those lengths and. They ask us, why do we do that? Why do we bother? They don't care. So know your clients as well before you start going through that much work.
Exactly. Did you want to say anything about that?
No.
Nope, we're good. All right, moving on. And then here comes 471C. So now we've told you how it was being done and how it's been for all of this, and now the apple cart is just completely upended. So the Tax Cuts and Jobs Act, back in 2018, did a lot for all of us. I'm sure we can commiserate. But what it also did was it brought in this idea that there is an undue burden for the small business.
Can you define small?
My small business is not $25 million. But, did they raise it to 26 now? Isn't it 26 now? Yeah, okay. So it was 25, now it's 26.
26.
Did it start at 26, and am I wrong?
No, 25.
Oh, okay. All right. I can be wrong. I'm wrong a lot. So here comes the apple cart. In 2018, let me tell you, poor Nick Fish from, where is he now? Greenspoon Martyr, I think. He and I did a couple of 471C and conference talks, and I was the never CPA on 471C. I have changed my tune. Because I had lawyers that spent enough time with me that they allowed me to understand where my risk profile was with it in signing a tax return. We are better together, people. 471C came in, and it created this opportunity that the cannabis industry immediately looked at and said, check, silver bullet. We're putting it all in COGS, baby, because we don't have to actually account for our inventory anymore because we're not making $25 million a year, most people, in 2018, at least all my clients. And all of a sudden, I started having a conversation which I hadn't had for years and years, which was, dude, you still got to apply 280E. Oh no, we're not going to do that. 471C protects us. 471C protects us. 471C protects. Now let's bear in mind and be clear, 471C has not been being audited yet. So if we are taking a 471C position, which many of us have to or do, I do now, what I come back to from the standpoint of legality is clearly reflecting incomes. What 471C was intended to do was give the small business that is non-cannabis relief from being able to have onerous accrual accounting machinations on their tax return and to count inventory, because it takes a lot of time and energy for little tiny people that have a lot of dog food or nail polish to put that on a tax return, and most people just weren't. I think frankly the IRS just went, uncle, because we all have had the $10,000 beginning inventory and the $10,000 ending inventory on a tax return for 19 years, and we just aren't doing it. And so this, I think, in good gracious, I really want to give the IRS the benefit of the doubt that they were like, okay, we're going to try to help you. But what the cannabis inventory industry came back to, it said is, we're small. We consider ourselves cash. We're mostly not doing financial statements. We're shoving it all into COGS. And so you may inherit a client that has done that. You may need to unwind something there. And again, because it is so short and deceptively sweet, just like 280E, guys, we're dealing with 2 sentences at a time. We're getting 2 sentences worth of guidance. And now there's FAQs on the IRS that supposedly give us more guidance, which they don't. But very, very short, deceptively short and sweet. Nothing permits the deduction or recovery of any cost that the taxpayer is otherwise precluded from deducting or recovering under any other provision of code or regulation, is the thing in 471 that they added in to keep us all from slamming costs into 471, all the costs into COGS. They added this flush language that was includable in 263 Cap A. And if you don't know, you can't use 263 Cap A for these businesses. But I'd love Jennifer Benda to tell me, for those businesses that are over the threshold and have had 3 years in financial statements, if that's true, because I really think it's an interesting question. 471C says, hey, you have to still count your inventory, which created a huge amount of confusion for people like us, because first they said 471C says you don't have to count your inventory if you're a small business. And they came back in and said, no, wait, I think you still do, if you're subject to Code Section 280E. This short, sweet, deceptively simple line item that they added is pointed at us and our clients. It is pointed at us to say, hey, we know that we gave you this relief, but we really don't want you to have this relief. So, in its actual language, a qualified taxpayer is allowed to be able to use this inventory valuation methodology on their tax return as long as their tax return and their books and records comply with each other. They are substantially the same. They included, interestingly, the accountant's work papers to get from books and records to a tax return in all of that, but not audited financial statements, not financial statements used for external purposes, and not GAAP basis financial statements. So if you are dealing with larger clients, maybe they're not $25 million, but they're subject to an audit, or they have an investor pool or a bank that's requiring them to be able to do financial statements, and you have book tax differences, this is not an inventory methodology that's currently available to them, which is important to understand when you're having conversations about how your clients value inventory. Because ultimately, your clients are valuing inventory not because they want to. But because we're asking them to do that for a tax return purpose or a financial statement audit purpose or financial statement purpose to clearly reflect incomes. That's our job, guys. If we're prepping financial statements, if we're creating the content to be able to audit, we're trying to clearly reflect something. And what is it? It's incomes when we're talking about 280E, because tax returns stop at gross profit. So what is gross profit then? Supposed to be clearly reflected income. But that's a tax return position. So as you're talking about valuing inventory, as you're talking about inventory valuation, as you're thinking about it conceptually, you are thinking about it from the standpoint of having to build a tax return position or understand the tax return position that's been built if you're auditing or you're working with financial statements. So again, at its base, for the non-cannabis person, it is a great and an amazing thing for the pet food people and the nail salons, because they don't want to count that inventory, and they can literally just say, hey, it's materials and supplies. It's part of our ordinary course of business. We don't have that luxury when the only thing we have is inventory valuation. We do not have, God help you if you say that inventory, any part of the inventory cycle is a material and a supply, because the IRS is going to come back and say that's SG&A, and SG&A is clearly not deductible under 280E. And I have seen it, but mostly, as Zach said, what I've seen are people that said, this is a silver bullet and we're going to make gross profit net income. Or we're not going to include anything at all. And again, I don't think either of those are right. We as the practitioner in the room need to be thoughtful in how we apply a 471C position so that it's conservative, consistent, defensible, not just for us and our clients, for anybody who follows our work. We're all trying to be better together. So 471C is not the silver bullet and it's not the devil. It's somewhere in between that you have to be more thoughtful about. And really, it is recognizing that inventory is on a cash basis. So here the IRS giveth and then taketh away if they say that inventory really must be kept on an accrual basis, but unless you decide to do 471C, in which case it doesn't have to be a cash basis, but you still have to apply 280E, and oh my gosh. So we must, in fact, work with the entire scope, the internal CFO, the people that are receiving financial statements or not receiving financial statements, those lawyers and people that might defend under audit what we are putting into an 1125A position, and us as a tax practitioner, what we're going to be comfortable doing and signing on an under penalty of perjury, because that's our 471C position. And again, like the joke is, you put 5 of us in the room and ask us about 471C, you're going to get 7 answers. Because it really depends on how you apply that with your client and who else is in the room in relationship to it. So for regular cash basis people, it's a great tax advantage. But for our cannabis business people, if we are going to use it, you've got to follow the rules. So not on top of it, you can't just change your inventory methodology. You really have to go through the process of a form. There's the 3115. You got to ask. There's a calculation involved. Again, 0 is the wrong answer. And many people just want it to be that. And then you need to charge because your time is valuable. And some of these calculations have run into 15 or 20 hours of my time, and maybe a tax lawyer, and maybe an ability to be able to make sure we got all the information right. And then they come up with a new number out of nowhere at the 11th hour. And you have to consider that. So these are facts and circumstance-based decisions that you're going to make related to where you are in relationship to these financials. And so 471C is still a very powerful position. I still think it's powerful for a cannabis business, but it's powerful because I'm willing to use it judiciously, and I'm willing to use it as a carrot to make the clients do better documentation, to use better technology, to do better in general, and bring all of this up to a higher benchmark standard. Because again, if you will not document it, and 471, in my opinion, requires 2 or 3 times the documentation of a 471 cost basis position, if you're willing to do the work, client, or you're willing to pay me to do the work, which they're not, if you're willing to do the work, client, I'm willing to consider it, but we must consider it in the scope still of the accounting process of 280E being applied, because you never can get around it, and that you have the ability to be able to have it be conservative, consistent, and defensible for all the parties involved. Do you guys have more?
Well, you hit it on the head, documentation. And make sure you're paid for your time.
Document.
Related to that, the question that popped up with the new 6-vote winner, what is your opinion with respect to what may have happened had the Lord case settling occurred after TCJA and that Lord qualified and opted to use 471C?
Can you repeat the question?
Is this Jeopardy?
So yeah, it's like
I take the question again for 1,000, please, Andrew.
So basically, what is your opinion with respect to what may have happened had the Lord case settling occurred after TCJA and that Lord qualified and opted to use 471C? So it's a little bit confusing.
I think the Lord case happened after 471C. Oh, right. I'm sorry. I'm getting the date that they put the court case through and the tax. The Lord case is the issue in the Lord case, unless I'm completely wrong, relates to whether or not you can use accelerated depreciation, which Dave had spoken to, for tax purposes, because it's not a book issue at all. I don't think it has anything to do with 471C, because I never, under 471C, 471A, and if I could use UNICAP, probably, would not allow because of 280E. 280E precludes that we cannot use an accelerated method of depreciation, because depreciation expense is technically an expense, and 280E says no debit or credit is allowed for a business that traffics. So in my position, there is absolutely a relationship to COGS fixed assets, and it should go into COGS, but it goes in straight line because it's conservative, it's consistent, and it's not something that there's an act of legislative grace, i.e. Congress can giveth or taketh away, that's involved in that position and that I'm willing to sign a tax return for. So I'm not sure if that answers your question from a tax return side, but maybe from a legal side you have a different answer to that? Or?
Well, I'm not an attorney.
I know that, but maybe from a legal side you have a different, like you've seen more audit in regards to the accelerated depreciation piece than I have, I guess.
Yeah, I mean,
why.
I think it comes down to, again, if you have financial statements, audited financial statements, again, there's the element of GAAP, so is accelerated depreciation really GAAP? No. And it isn't. So I think, I don't see any, if this case came down post TCJA, I don't see any change.
Yeah, I don't either.
Have the courts looked at 471C yet? Are we still waiting?
Not to my knowledge.
So we're...
No.
Which brings
the
up
problem with court cases is that unless they get pushed into federal and audit and appeal, like we don't know, right? So I advise clients when I sit down and talk with people of any size. I don't care if you're a $100,000 grow or you're a $100 million grow. We are ethically unable to answer the question, will you get audited? And what a stupid question. In cannabis, my answer is probably. And even if it's not probably, you might as well plan for it, because it's better to be prepared. There's some cute saying about that I can't think of in this moment. But, again, it's better to be prepared than not be prepared, because it's going to cost a whole lot of money to have to dig up all that documentation and all that work on a position you've taken and then come up under audit. So
or
we don't
even worse,
really
you have to go back in time and create the documentation, create the breadcrumbs.
I'm sorry, do you recreate mileage logs for your clients after the...
Is this camera on?
I'm sorry, I'm being a jerk. So yeah, I mean, but the point again, the method, I do not believe, or I have not yet seen a 471 case that's, I'm sure they're talking about it somewhere, but it's so new, they're so far behind. I mean, the government is so far behind, guys. Like, let's get back into just court cases and the like. That we're so far behind and we don't have a lot of precedent. And so what we have to do as practitioners in this industry is make conservative and defensible positions like the court would look at us. And if you're not comfortable with the number you've put on there, if it doesn't clearly reflect income, don't do it.
Now, I think, actually, I was going to say we have 1 minute left. I think we have no minutes left. But I think there's more questions, but I believe the next session is fireside chat for this very reason, right?
I think so. Good. Mitzi can give them all to Mitzi. Field them all to Mitzi.
And we'll do more questions on 471.
Anyway, thank you very much for your time.
Yeah,
Really
thank
complex
you all.
issue.
Thank you.
Continue to ask questions.
Document everything.